Are we live? Hi everyone. I think the spotlight is on Isha right now. Yeah, hi. Uh, Glad to be here finally. Hi Vivek, good evening, and thank you
Hi,
everyone.
Sahil. Good evening.
Hi. So glad to have everyone here live on a Wednesday evening. That just shows how much important investing and having knowledge about the markets is. And for exactly that reason, we have Vivek here from Gulaq and Estee Advisors. Uh, just to give you some idea about Vivek. So Vivek has 18 plus years of experience in trading and portfolio management services. He is working as a director of Estee Advisors and is one of the founding members of Gulaq. Gulaq, for everyone's reference, is Estee's robo advisory arm, focusing mainly on portfolio creation through multi-factor models. So hi Vivek, glad to have you here. How are you feeling today?
I'm good. Sahil, thank you for the introduction. Thanks a lot.
Right. So, yeah, Vivek, before we get started, would love to know how your experience has been in the markets and what mainly your learnings has been, especially given that we are apparently in a bear market per se, or at least definitely not in a bull market, given you must have seen cycles, right? How does it pan out? How long does it last? And, what can we see going forward?
Uh, Sahil, I wish I had that specific answer of how long it'll last, actually. So,
Right.
although I've seen couple of bear markets and the bull markets overall. Fortunately, I have been on the both sides. So, I have been trading actively in the first decade of my career, where I was primarily trading intraday financial securities which were listed in European or US markets, US exchanges. I've been trading actively commodities, FX, equities. So that was the first decade when I traded uh, very actively intraday. And for the last 5, 6 years, I have primarily been involved in creating strategies more around investing. So I have seen both sides, and I have seen very closely 2008 crisis, in which actually it was looking like that the financial world is coming to an end as we know it. Uh, and this time it's actually quite different. It doesn't look uh, anywhere closer to 2008. This time the challenges are totally different. Yeah, but I hope we are much better prepared uh, for the challenges ahead. That's what I feel.
So, when you say that you have seen the 2008 bear market, or probably even the crash of 2020, do you really think that it is a bear market that we are in, or is it just like a minor correction or consolidation, so to say? And going forward, it's going to be more of a sideways market. It could correct further. What are basically the factors do you think that it's going to impact the markets going forward?
I think the biggest factor is obviously the interest rate increase that we are seeing in the markets, and how that impacts inflation, and how well actually it's primarily more about US markets, I guess. I think in India we are pretty well placed right now. So I think India is not too much of a concern as much as maybe the US markets are, because US markets, obviously the inflation is much more higher than what we are seeing in India, and they are increasing uh, interest rates at a very rapid pace. And the risk majorly is whether they'll be able to control inflation without getting into a recession actually. So I think risk is primarily towards from the US markets. In India, we have hardly seen maybe 10-12% correction, which is technically not a bear market, right? And see, 5 to 10% of correction is even 10% we see every year or so, 10% of the correction, whereas 25% to 30% of the correction you get to see once in every 5 years, and a correction like 40 to 50%, which happened in 2020, you normally get to see once in a decade, right? So India, I think earlier we were definitely very, very expensive in terms of valuations. Right now we are kind of fairly priced. So we are not definitely not expensive, but we are definitely not even on the cheaper side. We are kind of, I would say, in the fair valuation territory, looking at the historical valuations. But again, see, nobody knows where we are going to go from here in the short run. We could see it mostly, I think, that would depend on the US, but we could see 10, 15 correction further from here as well. But we might see a sideways market for some time and then a move up. What we definitely know as a longer term investor is 5 to 10 years down the line, we'll be a much bigger economy. And the current companies that we are investing in, they are going to be much, much bigger companies overall. So somebody who stays invested all through these cycles is going to definitely reap the rewards in the longer run. Whereas what we have seen mostly in the short run is a lot of people who try to time the market, who try to see whether if we are going to go down, should we short the markets, or maybe I'll stop my, some of the very common mistakes that people make during bear markets. They get into that, and that actually impacts, most of the people are unable to do it well. And that's how it impacts their longer term returns. So there have been a lot of studies overall in US, Europe, Japan, that how well individual investors are able to make in equity markets the returns. And almost all the studies have shown that they are not able to realize even the index returns because they try to time the market. So I think we as investors, what we should just be bothered about is that whatever funds that I might need in next 2 to 3 years, I should just not have that invested in equities. If I don't have that invested in equities, I'm pretty safe in that case, right? Those should be primarily debt, your short-term needs, financial needs, and rest everything. If it is in equities, then you are pretty safe, because even if it lasts for 6 months or maybe 1 year or so, you don't really know how long it's going to last. But longer term, as I said, we are all pretty sure that we are going to come out of it well. And the equity markets obviously would be much, much higher in the longer run. Yeah.
Right. So interestingly, you mentioned about asset allocation, so to say, that how much should you have in, let's say, one asset class, and in the short term, and maybe another asset class in the long term, and accordingly. But I also know for a fact that ST has different products wherein investors can bucket, but I would love to talk about that later in our conversation. But before that, some of the interesting things that you mentioned was about rising interest rates, rising inflation, and a probable recession. So there seems to be a correlation in all these factors that you mentioned. And of course, we are now living in a global economy. Something affecting the US will also affect our markets as well, right? So it is, impermanent that we do talk about the global economy as well, and what is happening in the US. So because we are also seeing money flows, and which is negative for us, rather money is going out of our country, which is impacting our valuations as well. So what do you think, like how are these different factors of inflation, interest rate related, that might lead to recession? What is going on in US, and what needs to be done to bring things in check?
So see, I'll tell you, I would like to talk a bit about our investing philosophy, right? So personally, the way we approach this specific problem of where to invest, when I say where to invest, in which stocks or sectors to invest actually. So what we do is we try to take this problem in at least for India, it's quite new. We have been doing these this quantitative investing and trading for more than 12 years now, and in the West, it's very, very popular. Here, we are just seeing some products which are coming out, and we are seeing even in mutual funds, some of the best performing mutual fund is, I think the quant mutual fund has been doing pretty well. So we in ST have been doing quant investing for more than 12 years. And all these factors that you talked about, whether it is, say, inflation or high oil prices, or even the exchange rate, India versus the INR versus USD rates, all of these factors, they impact certain sectors and companies, all of them in a very different way, in unique way, right? And we as humans, there are two ways to do it. What is the traditional discretionary fund managers? They would analyze it based on their skill set, based on their knowledge. Whereas we in ST, what we try to do is we analyze all of this. We actually try to quantify everything. And then we try to see how all of these factors are kind of correlated or interrelated in a very, very mathematical sort of a way. And then we try to come at these systematic rules, which will help us guide which sectors are likely to do well or which stocks are likely to do well, right? So if you ask me whether a Reliance is going to do well, or a Paytm or a Zomato is going to do well, frankly, I would not be able to answer that based on the fundamentals, right? Because the way we look at it is our strategies. We have over 100 strategies or factors, you can call, right? And some of these factors that we mentioned, we also do look at that, but we also do look at company specific factors and sector specific factors. And based on that, what we try to do is we try to come out with a single score as to how well a stock is likely to do well. And based on all the rankings that we get from all of these factors, we also try to see in the current market regime, overall, speaking of macroeconomic factors, in these kind of macroeconomic factor regime, which specific stocks are likely to do well. So it's very, very, our approach is very mathematical in nature. So you would have seen a lot of people coming on news channels giving out their views on stocks or sectors. And frankly, we would never be able to do that because the analysis that we do is purely mathematical in nature. It's purely in terms of numbers. And those numbers, if I talk of one specific number of Zomato versus Reliance, it really wouldn't make sense to us as human beings, but machines understand that language. And that's what we try to do. We try to create those purely systematic strategies in nature. And we believe there are huge advantages over the traditional approach, because just because machines are able to do, as I said, we analyze over 500 stocks, and each stock we see over 100, about 130 factors. Human managers are frankly would not be able to process that much amount of data, right? And that's why we believe this is this kind of analysis or these kind of strategies do hold, definitely hold an edge over discretionary managers, right? So to give you the answer to the question that you asked specifically about these factors, what will happen? Frankly, we have coded all of these rules in our strategies. So we don't exactly know the sectors or the or the stocks which are going to do well, but we apply our minds on figuring out the rules. Actually, that is what we do, and that throws out the best stocks. And obviously, the proof is in the pudding that we have been live for more than 2 years now on small case, and we have been able to beat the benchmark indices pretty well over this time frame of that we have been live on small case.
Right. I mean, the performance is, of course, a testament to the soundness of your strategy. And before we dig deeper into how your strategy works and what are your thoughts as to how your strategies and small cases are going to manage through these times, we already have a few questions coming in, although a bit ad hoc from the theme that we're talking right now, but very important given that this is an AMA session. We do cater to the questions as and when they come. So we have a question from Nilesh Raj here, who is asking, lump sum versus SIP via small cases. Is it a better mode of investing till this bear run lasts? Considering lump sum comes with its own issue of timing the market, right? So this
Yeah.
is more of a general question, that is it just bear markets, especially right now, or in general as well? We could just dive into both of these questions.
Okay, see, I think we have definitely done studies on which specific strategy makes sense, whether it is the lump sum uh, or SIP. And to tell you, we studied last 20 years of markets, the data that comes along in India also and abroad also. And our research has shown that at least in India, we have just had around 20 to 25 years of data in India, reliable data. So in India, what we have seen is it really does not make too much of a difference whether you are investing lump sum or SIP. So there are kind of equal chances that in 50% of the cases, lump sum have performed better, whereas in rest 50% of the cases, the SIP has performed better. So it's kind of equal probability, at least if you look at in India. If you look at slightly larger data of maybe almost 100 years in US and in Australia, UK, if you look at that data, the results are slightly favoring the lump sum one. So lump sum is slightly better than SIP over much longer time frame of 50 to 100 years. But having said that, these results are the advantage is it's not really so much. So I think my answer it'll really boil down to your personal preference. Frankly, it won't make too much of a difference whether you're doing lump sum or SIP. So, but what will make the difference is which approach you are more comfortable with. Right? For me, frankly, I am much more comfortable in SIP. So whenever I have to invest some lump sum money, I almost never do it, even though the markets would be lower. I'll break it down into, say, next 3 to 6 parts and would invest over the next 3 to 6 months. That is what I always do, even though I know the data is slightly favoring the lump sum. But see, I am able to, I don't want to be on the luck side, whether actually if the markets rally from here, then the lump sum would do well. But if they come down, the SIP will do well. But I am much more comfortable. That's just a personal preference, frankly. I've told you the data slightly favors the lump sum one, but it's not so much. So it totally will boil down to your personal preference. If you feel that you are much more comfortable in SIP, go ahead with SIP. That's the one I also prefer, because it just takes away, it brings in the system to your investments, and it takes away all the luck that market you are lucky or unlucky. It takes away that factor. So I am much more comfortable doing SIPs actually.
Got it. So that is a very interesting insight, in the sense that you are clearly saying that lump sum have had historically made a bit better returns than SIPs.
Definitely.
But nonetheless, SIP is a much more better way to invest and have a peaceful sleep at night, so to say, because then you don't have to worry about timing the market, and what if the markets fall from tomorrow or whatever it may be, you can keep averaging up or down your investments. Great. So I think, Nilesh, I hope you had your answer. Then we have Rajat Katuria, who asked, Dear Vivek sir, I really appreciate your thoughtful comments and perspective. Thank you for sharing. Okay, that's a gratitude that Rajat is sharing. Vivek, thank you. Yeah. Moving on, we have Chirag here, who's asking, considering real returns are negative for most debt instruments owing to high inflation, and equity markets are also going down, any alternate investments that you would recommend? So this is interesting, because this calls for your opinion on both debt and equity.
Yeah. See, frankly, we are in the TINA regime, which is, there is no alternative, frankly, in this regime. So I think these are, frankly, shorter term issues that we are going through. Over longer run, what will make sense is definitely if you have invested as per your risk profile. I think asset allocation is one of the most underrated things in investing. So if your asset allocation is right, and if you just keep rebalancing as per in order to follow that specific asset allocation over longer run, I think you would just be fine, right? So frankly, there is no alternative right now. There are hardly any alternatives. I for sometimes feel that maybe real estate is one sector which should do well, but estate has its own challenges in terms of the ticket size, in terms of the liquidity. All of those issues are definitely there, which are not there in equity and debt investments. Uh, that is definitely there. I think real estate is something which, and these are my personal views, I could be wrong, but I feel that since real estate hasn't really gone up last couple of years, I think there's very limited downside to real estate, and we see on ground things picking up, and there's pretty good demand in terms of booking that we have seen over the last few quarters. Those bookings are uh, increasing as compared to Q1Q or year on year. They have given good indication that we might be in for a surprise in terms of real estate returns. But again, that has its own challenges in terms of, as I said, ticket size and both liquidity.
Got it. So will it be safe to assume that given the data points that you have shared, real estate is probably a sector that is taken up in your Estee or Gulaq investment products?
So see, in Estee, what we are mostly focused on, not mostly, but what we are focused on is the listed securities. So obviously you have other asset options like VC investments, PE investments, or real estate, but we are only focused on the listed instruments, the exchange listed instruments, which is the equity and the debt, right? So like our official view, obviously we and if you talk about listed instruments, there are REITs which are listed in India, but the options are really very few right now. I think that is one space which will be exciting. Maybe next 5 years or so, we are going to have many more REITs which are listed. And as of now, they are only commercial REITs. We are going to have many different kind of REITs going ahead. That's what my belief is. And that will be at the time when we might consider REITs also, including REITs in our portfolios. But as of now, they are very limited. The data is also very limited, and there are very limited number of REITs which are listed. So that's why we haven't included it in our portfolios. But yeah, going ahead, definitely we might be including it as and when we get more data and more options in that.
Got it. So that will be an interesting addition to Estee's products,
definitely,
and further diversification for investors who would like to have more asset allocation as part of their overall portfolio. Great, glad to know that. And yeah, for people who are new to the terminology, REIT is basically real estate investment trusts, which is basically a way to invest in real estate via the listed security space. Yeah, we can get into more details, but yeah, you could definitely look up and Google it up, or if you would like to know more from Vivek itself, feel free to drop in the comment section below. Right. Moving on, I think Rajat Katuria has a question that how different is Estee and Gulaq, and what are the different kinds of products or services that you're providing under the two banners, so to say, and would love to actually get some more insights into the history of Estee and Gulaq, so to say.
Okay. So Estee has been in existence for more than 12 years. It was founded by Sandeep Tyagi, who's an alumni of IIT Delhi, and he went on to do his MBA from Columbia University. So he founded Estee, I think in 2008, after the crisis. And his idea was that there has to be a good systematic way of managing one's investments. So at that time, we have been now hearing about systematic investments and robo-advisory, but that was his vision way back in 2008. And that's when he started with that vision. He started Estee, and Estee has been doing quant trading with our own funds, proprietary funds. And we have also had a very successful PMS by the name of iAlpha, which is into debt and which has never had a losing month in the last 10, 11 years that it has been into existence. So that says a lot about our capability as a quant team, right? So last 2 years, we figured that we have been doing this thing for mostly for ourselves or for HNIs for which these PMS products are catered or targeted towards. So 2 years back, actually, we thought we should be using our expertise in order to serve and advise the retail investors as well. And that's how Gulaq was born. So in ST, we have a couple of other PMSs and AIF, which are again purely 100% quantitative and systematic in nature. And Gulaq is a brand which is focused on advising retail investors on their investments. Again, everything is systematic and quantitative in nature. And in Gulaq, we have products ranging from starting from about 5 to 10,000, going up to 2.5 lakhs, which is the Gulaq Wealth portfolio. And our philosophy in Gulaq is that you would have seen many other managers who keep creating portfolios based on short-term themes. Now, those themes are okay, but as an investor, as a retail investor, then I have got to be always thinking about which theme is going to work well in the next 1 or 2 quarters. And then I have to time those themes exactly. That if this theme is working, I have to get in at the right time. But more importantly, when that theme is not working, I have to exit, right? So you have to time the market or time the theme. So what we are doing in the background, we are doing exactly that. So as I told you, we have 130 themes or 130 factors. Now, each of these could be considered as a separate strategy, and we can actually potentially roll out much more larger number of portfolios. But what we are doing in background is we don't want a retail investor is definitely not well equipped to take that decision. So what we are doing in the background is out of those 130 themes or factors, which are the factors which are likely to work in the near future, we select those, give weights to those, and we don't give weights to others, right? And that is how what we are expecting from retail investors, that they take that decision. We are taking that, we are doing that heavy lifting, we are making those decisions. So in the end, you get those portfolios which are updated and targeted towards what is going to happen in the near term in terms of stocks or in terms of factors.
Right. So the key takeaway here being that even themes are short-lived, and you have to be on top of the industry news, or so to say trends, to catch them at the right time. And of course, as a retail investor who actually get information way later, when after the trend is already much into play, it's better to go through these quant strategies, probably that ST or anyone else is building, which already encapsulate these themes into their overall diversified portfolio, so that investors themselves on a personal level do not have to do that much research and can rely on the expert whoever they are going with.
Exactly.
Great. Rajat continues to have interesting questions, and following up is that, could you please elaborate on the macroeconomic variables used to characterize the macro regime? Basically, what are the factors that you have incorporated in your, let's say the 130 factors that you're taking into consideration? Are these only financial variables, since there are hardly any macroeconomic variables published at a monthly level?
Definitely these macroeconomic factors, they don't change so much on a monthly basis. You are correct, but maybe they change on a quarterly basis. We do take into account monthly rebalancing, because the other factors which are much more, which could change over the month. So the other, apart from those major macroeconomic factors, we have factors related to stocks or sectors, right? And these factors again could be categorized in two ways. One is quantitative or technical in nature. So one which studies momentum, how well a stock is into momentum, technical factors like that. And then we have fundamental factors also, how well a company's earnings are growing, how well its revenues are growing, and all the financial ratios as well. So when we are talking about these 130 odd factors, it's a combination of both those fundamental factors which discretionary managers also study or analyze, and they also consist of quantitative or technical factors. And then over the top of them, we have these macroeconomic factors. So that's how we work. And to give you some flavor of it, we do have factors like obviously what the FIIs are buying or selling, but not only FIIs, what the insiders, as in the company's management. So that has been a very strong indicator. So whether the company's management, how much they are holding and whether they are increasing or decreasing their stake over time, right? So that is one of the factors. Another factor is you would have heard about index inclusion and exclusion, that a certain company has been included in, say, Nifty, or it has been excluded from Nifty, right? So again, this factor becomes a quite prominent one, and that is also one of the factors that we keep tracking. And it's not only post facto that when this event has taken place, when a stock has gone out or has come inside, rather we try to predict whether a stock, which stock are likely to go out of the index and which stocks are likely to be included in the index. And then we take that also into account, we give it weight and see overall how big an impact that can have over the potential returns over the next few months, right? So these are the kind of factors that we study and come up with a consolidated score.
Right. Rajat, interestingly, is following up on what you just said, stating that sure, factor construction can be the first step that you focus on. But if the macro regime is changing, so he mentions macro regime modeling. So I am presuming that it is about, let's say, the factors are in place, but because of a external shock in the macro bigger regime, how does that get taken into consideration?
Yeah, so that, like I think a bit I touched upon earlier. So these macroeconomic regimes, if they are changing, see, what we try to do is over and above these factors, there's another layer in which what we try to do is we try to see in the current macroeconomic regimes, which are the factors which are likely to do well. So let's say if the economy is expanding, there are certain factors which are likely to do well. Whereas if the economies are in the contraction mode, then there will be different factors which will be at play, which are likely to do well, which will of course be different from the factors which were doing well in an expansionary regime, right? So that is what we try to study or analyze over and above these factor models, that which are the factors. And I think that's the secret sauce actually, essentially. So that's the secret sauce of Estee or Gulaq, that that specific layer in which we try to study which are the factors which are likely to do well in this specific macroeconomic regime and give weights to that and reduce weights to the others, right? So we do definitely take into account, and that is, I think, that is what makes us stand apart from the other quantitative models which are there. Because if you see most of the other quantitative strategies which are out there in the market, they mostly focus on one of these factors. And obviously we all know the most popular factor is momentum, which has been doing well for many quarters, but last couple of months it hasn't been doing well. Whereas another factor which is not so popular and for a right reason is value. And what has happened in the last decade or so, value as a factor hasn't really performed that well. I think over last 9 years or so, it's only over the last 1 year or so that value as a factor has been performing well, right? So these are some of the most popular factors, and that's what we try to study in our layer, which is just above that factor, that which are these specific factors which we should be concerned about in this regime, which are likely to do well, right? So that we do definitely take into account. And that's why that is the secret sauce, and that is the edge we believe we have in our portfolios.
Okay. Now, given this gets very interesting, and users would love to know what are you looking at. So, point being, what is the regime that we are currently in, and second, what are the key factors that are driving Estee's portfolios right now majorly, if you would love to share?
See, as I said, it's very, very quantitative in nature. And if you are asking me which are the factors or which is the regime, because all of these, we get scores. And if I tell you these are the scores of this specific factor, which frankly, I also don't know, because what we look at is the final output, what we are getting at, right? So if I talk about those specific numbers or scores, they won't make sense to you or to me as well, right? So I don't think we can talk about that, but I can maybe tell you specifically about our portfolio currently, that which are the sectors actually we are more focused on. And I think utilities is one sector that we have heavy allocation to. So utilities, we have almost 40% allocation, whereas if you see in BSE 500, utilities is less than 10%. Another factor which we have more weight is industrials, where we have almost 20% weightage as compared to, again, less than 10% in BSE 500. I think these are the two big ones. Another is obviously consumer staples and healthcare. We have seen historically also they have done well in high inflation regime, and we have almost 10% allocation to each one of those as well. So I think, yeah, so our major focus has been on industrials, utilities, and to an extent, healthcare and consumer staples.
Okay. I would rather like to congratulate people who are attending today, because they now get an insight of what sectors might perform well as per Estee or Gulaq, basis the research and the factors that they are looking into consideration. So make the most of it with the information that we have shared here right now. Okay, moving forward, Malika has a question that, thanks for your insights, Vivek. What is your take on gold as an asset class, as it's considered as an inflation hedge too? You suggest allocating some percentage to gold and increase that percentage during times like these. So what is your opinion on gold?
Gold has been an interesting asset class actually, primarily because we have seen tons of data. And let me tell you, this factor research that we are doing, it's not only that we are doing this factor research in India, but we are doing in 6 different geographies, which includes US as well. So we do have a pretty good understanding of how these factors work and these regimes work. But gold prices, it's frankly decided by global macroeconomic factors. And what we have seen with gold is, it to an extent, it gives some stability. Oh, again, talking about longer term, it gives some stability to your portfolio, definitely, but it comes at a cost. So it comes at a slightly cost in terms of reduction in returns, right? And what we found out was that the reduction in returns is much more than the reduction in returns, which is the cost, right? So the cost you are paying to achieve that stability is very high. And that is why we have not included gold in our portfolio. We believe that on a risk-adjusted returns basis, gold is not a very good asset class to be in, right? So it really doesn't help us so much as it's costs us in terms of reduced returns. And again, gold has been interesting because if you look at equities and if you look at India, I think there would have been no 5-year period in which equities would have given a negative return. So you pick any 5-year period and equities would have given a good returns. Whereas if you see gold over a 5-year period, it could have been very, very, very much into negative also, and it could have given very high returns also. So gold, if you see as an asset class, it has a pretty wide dispersion of returns on any time factor, if it is 5-year or even it is 10-year. the range of returns that you can achieve from gold is pretty high. So even in terms of 10 years, you would see there have been many 10-year periods where gold would have given you negative returns, right? And that is why we thought that gold, maybe why it is not a good asset class to hold, is if even over a 10-year period it's giving you very high negative returns, then it's really no point having it, because at the end of the day, whatever we are investing, we are saving or investing, we are doing it for a specific financial goal in mind, right? So
Right.
in order to achieve that financial goal, we have to have uh, much more certainty in achieving it. Although it could never be 100%, but we have to have at least whatever 60, 70, 80%. The higher it is, the better, right? But having gold in your portfolio actually increases that dispersion or the range of returns, right? So that's why we don't have it in our portfolios, neither we do recommend that. That's what our thought is about gold.
That is very interesting in terms of how contrary this analysis of yours is, but very interesting in terms of how you are talking about rolling period returns, and how if you take any 5-year rolling period, equities perform better, so to say, than gold on any rolling period return greater than 5 years. So you don't see much diversification benefits if you add this asset class to your overall portfolio.
Yeah, see, frankly, what she mentioned, I think, is obviously in the high inflation regime, gold returns have been traditionally good. But again, then we don't know for how long this is going to last, this inflation regime, right? It takes very, very long to play out. And that's why, and again, if you connect it back to the range of returns that we can expect, it's very high. So that is why gold is very, very tricky. We haven't seen clear benefits in having it. When I say clear benefits, again, I'll go back to the rolling returns. So over 5-year or over any 10-year period, we have seen that having equities is almost always a no-brainer. Whereas same conclusion you cannot make out of gold, right? And that is why if you can't make that sort of conclusion, then why have it? We didn't find any strong reason, frankly, to have gold in our portfolios.
So Malika follows up with the question that she had asked, is that, so does it mean that for a low risk investor, risk adjusted returns are better for debt as compared to gold? Could we say that?
I won't say that. Risk adjusted returns are definitely much better in terms of debt, even for even more than equity, but risk adjusted. So if you just see if you're not seeing the absolute returns, so risk adjusted returns is the Sharpe actually. In technical terms, we call it Sharpe. So for that, definitely it's the highest, right? But having only debt in your portfolio, you'll barely be able to beat inflation over longer run. Right. So in order to beat inflation, we have seen that equities is the best bet for you to beat inflation over longer run. So equities post inflation, it gives anywhere between 5 to 7% returns by equities. So yeah, if you just measure your or analyze any specific asset class on the basis of risk adjusted returns, definitely debt would be way, way higher than equities or gold. But the absolute returns, if you see, obviously it's barely able to beat inflation. So that's why that is my answer.
Okay, got it. So in that case, I think the question was more around, let's say, for a low risk investor, diversification with debt is good enough, but it then, sorry, yeah, please go ahead.
Yeah, exactly. That is what you need actually. So in terms of if you are a low risk investor, you just have to analyze. You can take any surveys, and we at Gulaq have also developed few surveys, which we'll be making it online in next couple of days or weeks. But you just go and take these risk profiling surveys, which will give you a pretty decent indication of how much equity and debt you should be having, right? And that is pretty much what you need. As I told earlier, asset allocation is a very, very underrated thing overall in our financial planning. But if you figured out a specific asset allocation, and even when we were talking about REITs, right? So we have studied, there's a lot of data which is available for REITs in US markets. So we have studied data, and even if you take REITs in US, and if you try to construct a portfolio of uh, a REIT, which is real estate, debt, and equity, right? So the same risk reward characteristics can be obtained just from debt and equity. So even if you see that real estate is adding no real benefit in terms of risk adjusted returns to your portfolio. So I think debt and equity are pretty much what any and every investor needs. And if you are just able to identify a correct asset allocation and stick to it, you can pretty much achieve all your financial goals, and with much more amount of certainty, right? So even REITs are not able to add so much of value in terms of risk adjusted returns. The same characteristic you can actually get just by debt and equity. That is all what you need.
Got it. Got it. So before we move on to the various products that Gulaq has to offer and how debt and equity are taken into consideration to build these products, I would rather first like to know, given your opinions on gold and debt and also about timing the markets, how did Gulaq basically manage the fall in 2020, and how are you managing it in the current regime? In the sense, are you trimming your positions in equity? Are you building your position in debt? Or are you building cash positions to deploy it later on in the cycle? How is Gulaq managing their portfolio historically in, let's say, the 2020 crash and right now?
Right. So I think in this, Sahil, what I'd like to point out and clarify here is uh, that we, as a company, we don't believe in timing the markets. So had we believed, we would have maybe wanted to shift. If we had a view that we are in bear markets and we are expecting them to fall, we would have obviously shifted from equity to debt or maybe to cash. But what we know kind of for sure is we can't do a good job of it, and we haven't seen anyone do a good job of timing the markets. So when I said asset allocation, that is what we believe in. So we have our portfolios from gear 1 to gear 6. Gear 6 is 100% equity, which is meant for very aggressive investors. Gear 4 and 5 is meant for moderate kind of investors. Gear 2 and 3 are much more for conservative investors, right? And with each gear, your equity also increases by 20%. So a gear 1 portfolio would have 100% debt. Then gear 2 would have 20% equity and 80% debt. And gear 3 would have 40% equity, 60% debt, and so on and so forth, right? So one is the point that we believe that nobody can time the markets well. So there's no point getting into that. That's why we have decided on fixed asset allocation. And that asset allocation, if you see, that is primarily a very good way of timing the market. So let's consider a gear 4 portfolio, which would have 60% equity and 40% debt. So tomorrow, if you decide that gear 4 is what is meant for you and you decide to invest in it, and you decide that 60-40 is what you should be following, right? So in a rising markets, what will happen is the 60 rupees, let's say you have put 100 rupees, so 60 rupees go to equity. In the rising market, that 60 will rise to, let's say, 70. And your debt part would be at 30%, right? So when you rebalance your portfolio, what you are doing effectively is you're taking some money out of the markets, out of equity, and putting it in debt, right? So just think about it. In the rising markets, when you're taking out money systematically, what you're doing is you're effectively booking the profits, right? The more higher it goes, you'll take out more from equity and put it in debt. And then in times of corrections like this, what will happen is if you have been following 60-40, your equity part would be obviously in losses. Let's say it's 55 and 45 in debt. And then what you are doing when you are rebalancing, you're taking out money from debt and putting back into equity. So just think about it. In the rising markets, you're booking your profits, whereas in falling markets, you're increasing your shifting money from debt to equity, right? So that is a very, very simple yet very effective way of timing the markets. Your money will keep churning between equity and debt, absolute will remain the same 16. In terms of percentages, it will remain the same. But absolutely, if you see, it is actually what you are doing in effect is you're booking your profits, and then at lower levels, you are putting money back into equity markets, right? So that is why we just have these specific portfolios which are risk profile based. And if you're following that, you are actually timing the markets pretty well in terms of booking your profits also, and very systematically. You don't really need to know whether the markets are expensive or undervalued, right? So your asset allocation actually is taking care of it. You don't really need to know much more than that, frankly.
This is very interesting because there are a lot of strategies wherein it takes cash calls into consideration, whereas Gulaq already has products that inherently takes care of this allocation by having different geared products. I love the naming of your products, by the way. So Gulaq Gear 3 or Gulaq Gear 5 already has, let's say, 60% debt or 20% debt, and based upon your risk appetite, you go with the product, and the product takes care how much allocation needs to be shifted between equity and debt. And basically you don't have to worry about timing the markets, whereas Gulaq Gear 6 is more of a 100% equity product and is more in line with Estee's and Gulaq's strategy of being long only, and rather than, instead of timing the markets, finding the right factors in different regimes and staying invested all through it. Am I correct, Vivek?
Yeah, exactly. Right.
So, okay. So can you just elaborate a bit more on how Gulaq Gear 6 works? And right now, how are you managing it, given that you said that you're not taking cash calls and you are still
Yeah.
100%?
So in that, what we essentially do is we just try to focus on the factors that are likely to do well in this regime. That's about it. So as you see, we have shifted to utilities and healthcare, which are mostly kind of safer sectors to be in. And this is not coming from our knowledge or understanding of where we should be. It's purely coming systematically. So what this helps us is, um, one of the major drawbacks of discretionary investing is uh, having, when these human managers are taking these calls, we have our own biases, right? And that impacts our decision making a lot, both obviously in positive as well as in negative way. Whereas when you are systematic, those biases don't come into picture. And if you see very clearly, our systematic strategies which are showing that maybe we should be shifting more towards the safer sectors, and maybe not target sectors which are much more aggressive in terms of growth. And whereas now we are shifting more towards, say, value, or towards much more safer sectors. So this automatically gets taken care of by our strategies, right? And when we see the markets are turning around, and prices and the fundamentals will keep telling us. So we have factors which are based on prices also, and based on fundamentals. And whenever our strategies see that there is good uptake, both in terms of prices and fundamentals, we'll again shift back to our aggressive factors. But as of now, we are playing it safe and allocating more towards the safer sectors. And that's what, like, our strategies are doing. When we say we are doing, that's what the output from strategies have been.
So interesting how different managers and different investment styles, manage during these times. One school of thought is basically, long only, and we'll buy fundamentally good companies and we'll stick through them. Then there
Yeah.
are other strategies who take cash calls to be able to buy at lower prices or trying to time the market. Whereas Gulaq falls into the third category, which takes into consideration different factors, and accordingly, based upon whichever factor is more in favor based upon the current market regime, you shift into those. So you play safer during these volatile times, and you take more aggressive calls when the market seems more positive and in more of an uptrend, so to say. So
Yeah.
I think this will help investors make a decision as to whether they relate with your strategy and does it make sense to them and should they invest. uh, you also have asset allocation, small cases, so that also gets taken care of. Apart from the equity side, you can also have debt, right? Great. So one of the last few questions, one is that, let's say, if there's a major how frequently do you rebalance, number one? And if, let's say, there is a major market event, right, would you rebalance off the frequency? that you have decided for your portfolios?
Yeah, this is interesting because we at times have been getting these kind of queries even from our existing investors. Um, so what I would say is we in fact do rebalance every month, right? And a couple of months back when Russia-Ukraine crisis was at its height, at that time we were getting queries as to whether we would prefer rebalancing mid-month. And that is what we have got to be aware of in any systematic strategy. We should not try to override that specific strategy. So even though we might be feeling as a human manager that markets are about to fall, let's say, but we should not try to do, because we have seen the data. So we have seen the data historically, and this data is not only in India, but in US, we have seen more than 50 years of data, and in other countries. And what we have seen is, first of all, rebalancing at, we have tried smaller rebalancing frequencies and higher rebalancing frequencies, right? From weekly to quarterly or even 6 monthly. And what we have seen is our strategies, the way we work, they give us the best results if we are rebalancing on a monthly basis. And this is after counting for, say, short-term capital gains tax and the slightly increased transactions that we are going to have. This is even accounting for that. Our strategies have been able to produce much higher risk-adjusted returns if we rebalance on a monthly basis. that is the first. And second thing is, see, if we get specific stocks, stock-specific news, most of the times, many times what will happen is the price that we see right now, it already has all the information that is there in the market. So what that means is the market, if it has fallen right now, it already had all the information which is there available. And if a new information comes, see, what I'm pointing to here is, maybe if we had the opportunity to rebalance intraday, which we really don't have in small case, and which we should not have, because we are not targeting traders here. We are much more focusing on building longer term wealth. So if we are maybe very short term traders, intraday traders, maybe if we get that news in time, which is again very rare, because now the information spreads out so fast that there is hardly any advantage in terms of time, right? So if you are an intraday trader, maybe you have some edge in capturing that specific news-based alpha which is out there. But if you are more longer term, and even if you are rebalancing, let's say end of day, then really it really won't help us too much if we rebalance, if we take our specific view and try to rebalance mid-month. So what I'm trying to say is, the main point why we have chosen to follow systematic strategies is, a system, when it is put in place, has its own certain advantages. And if we are trying to override that specific system, then there is no end to it. We really don't know when I should be overriding and when I should be not. Then that systematic system, in first place, it doesn't really serve any purpose. So we have, in fact, never done it, and we don't intend to do anything more than a monthly frequency of rebalancing.
Great. So I think this must have given our viewers and prospective and our subscribed users as well a very fair idea of the investment philosophy at Gulaq, what are the different products that Gulaq has on offer, and how frequently do they rebalance, why do they do rebalance, how the portfolios are constructed. And with this, I would like to share the the discount code that we have been waiting for. So the discount code for subscribing to Estee Advisors and Gulaq small cases is basically Gulaq AMA, GULAQ AMA. We'll also be putting this code in the description, so you guys can check it out. And yes, thank you so much, Vivek, for taking out time on a weekday and in educating our investors, and to all the viewers as well. Thank you so much for taking out the time on a weekday and joining us to learn more about the markets and more about ST products. Thank you so much.
Thank you, Sahil. It's always good to interact with you.
Lovely to have you here, sir. Thank you.
Thank you.